Thank you. Today, we are going to touch the subject that is where technology and financial innovation touch. We're going to talk about how fintech law can unlock liquidity and broaden the access of Chile to capital markets. Sorry, I guess I missed to say good afternoon. Good afternoon. I hope you had a great lunch. And again, although I presented in the other panel before, just if you were not there, I'm Macarena Navarrete, Invest Board Member and EY Chile Managing Partner. So I was saying here we are in the place where technology and capital join, where Chile fintech law promises a lot of clear rulers, safer roads, maybe some faster lane for innovation. Today we will have a simple goal, not necessarily easy, which is to cut through all noise and ask what this means. What this means when the assets are digital, when the wallets are in our phones, and when the scammers really never sleep. But we are in excellent hands. We're here with Solange Berstein, President of the Chilean Financial Markets Commission, who pretends to turn principles into practical rules. We are also here with Adam Gagen, Global Head of Government at Revolut, who has a front row view of how countries are approaching digital banks in their environment. And Pia Aqueveque, who's a token economist and technologist, who can tell us about tokenization and tell us if that's a buzzword or if it really unlocks value. Three themes will guide us today. Keep people safe, unlock liquidity, and widen access. The idea is not to oversell this, nor to downplay it. No drama, just evidence and experience. So I'll keep it moving and have our panelists, let's hope that they keep it clear. And you can save your questions until the end. Unfortunately, only if we have spare time, we will ask 3 questions to each of the panelists. So let's start. Solange, so please help us understand how does fintech law address crypto-related issues, and how is the CMF addressing them through its regulation?
Thank you, Macarena, and thank you, everyone. I hope we will be able to keep you asleep after lunch. Well, the fintech law, it's very wide law. It involves a lot of different issues, and it includes also open finance, which we're not going to tackle in this panel. But it has been a huge amount of work for CMF and for the private sector as well. And in terms of the objectives behind this law, it is financial competition, financial inclusion, but also preserving financial stability. And it's very important to keep that in mind. There are certain principles that we have to indeed make real through regulation, as Macarena you just mentioned. Our principles under the fintech law are proportionality. So we have to have regulation that it's proportional in terms of equal activity, equal risk, equal regulation, which is not that easy. Technological neutrality as well, so understanding technology to also be neutral about technology, so really going to the risks behind it and not the technology itself. Modularity in terms of having different activities and assemble them in a way that allows different business models to be comprehensive as well, flexible. So there's a lot of different principles that we have to look after while drafting the regulation for the fintech business. And indeed, when we talk about crypto, we have to also think about these principles. In terms of the activities that are included in the fintech law, each of these activities we need to think about when the underlying asset behind it, it's a crypto, because it's all through the fintech law somehow. When we talk about, for instance, financial advice, investment advice, well, investment advisors are within the perimeter of the fintech law. And we have to regulate financial advisors, also financial advisors that advise buying cryptos. So what are we going to ask to them? Well, exactly the same that we ask for every financial advisor. So there's not much difference between what we're asking in terms of knowledge or in terms of transparency or conflict interest resolution. So the things that we are asking for a financial advisor that recommends cryptos is basically about the same. But these assets are very complex and very risky. So it's not about what we're asking them, but it's about, again, the risk of the asset that they are offering to the public. So they have to be very careful. And indeed, when you think about financial advisors that offer cryptos, usually they do it by social networks. So in that sense, also the way in which they get to their clients is digital, and it's easy for people to engage in very risky investment without not necessarily knowing enough. Also, when we talk about crowdfunding platforms, well, IPOs, when they're crypto, is the way in which the client is engaging in a certain investment. Also, there are certain things that we need to look at. And again, that's another fintech activity in which there is a service that can be provided with cryptos. Also, alternative trading systems, order routing services, financial intermediation, and financial custody. So all of them can be offered, crypto assets can be offered services by a fintech company. So these crypto asset service providers need regulation, which is almost the same for any other fintech service provider, but there are certain differences, for instance, in the case of alternative trading systems in terms of disclosing conflicts of interest, and also understanding which are really the activities that this crypto asset service provider is offering. And that has been very, very difficult in terms of understanding the business models, because when you talk about, for instance, an alternative trading system, is this just an exchange platform, or really they are offering intermediary services? Are they also a broker? Or are they also a financial advisor? And the way in which we are regulating these activities and the way in which conflicts of interest can arise in terms of having vertical integration of different activities, it's very complicated. And indeed, when you look at international principles, usually what is recommended is that these conflicts of interest need to be very well assessed and managed when there's integration of different activities. So sometimes even it's recommended to segregate these activities. So, well, we can talk a lot about, also in terms of the custody and intermediary activities, we ask for capital. So there's different things that we do address the crypto assets as a service provider by fintech companies, depending on the activity, basically.
Thank you, Solange. Adam, given the US push for adoption of USD stablecoins, how should Chile and other markets around the world respond?
Tough question. Very political on the visit of the US president to London this week as well. Careful what I say. Just a quick sense check. So again, my name's Adam Gagen. I head up global government affairs for Revolut. Hands up who's heard of Revolut before? Okay, not too bad. This is good. It is the right place, fintech conferences. Exactly. Have an account as well, hopefully. I have the regulator in them, a lot of Chilean nationals. So that's good to know. So as most of you therefore are probably aware, we're quite a young company, but we've grown up fast. So we're 10 years old. In that time, we've scaled to be now operating in about 41 countries, primarily as a bank in the majority of those countries. We've now scaled to have about 60 million customers globally. We're adding about 2 million new customers a month, which for a financial service organization is quite fast. The really interesting thing is we've built that as a bank. So we are not trying to go for light licenses around the world, do AMIs and other services. We're trying to operate as a fully regulated bank. So we're directly regulated by the ECB. We've been authorized here in the UK, authorized in Mexico. We've got a dozen other bank licenses around the world. the thing that's really interesting when you talk about stablecoins and the entire crypto ecosystem is we're offering crypto activities along with issuing credit, issuing insurance products, providing payment services, providing deposit and other saving services as well. And when you talk to central banks around the world, to put it politely, there's a high diversity of thought on crypto, and particularly the stablecoins, and the pros and cons for the financial ecosystem. What we really look to do is to make sure where our customers saw a demand and a need to be involved in the crypto space, or now increasingly to have exposure to stablecoins, we would much rather they do it with us than going to a pure play crypto provider or going to potentially a pure play stablecoin provider. And it goes back to Solange's excellent point, which is around what is the business model of the people providing these services? Is it sustainable? And is it essentially aligned with the incentives of giving good customer outcomes? And so to be very honest, we have a very diversified revenue model. We make money from people making payments, buying shares, buying crypto services, making insurance areas. Any one of those things cannot be very active, and we can be a sustainable financial body. Our concern, looking over the last 10 years and the waves of interest and innovation in the crypto space, we think this will be the case in stablecoins, is sometimes you have markets which are very high, sometimes you have markets which are very low. And if you don't have a diversified and stable system to generate revenue, it creates a lot of new risks into the financial ecosystem, not just new risks for financial regulators, but also in terms of consumers themselves. If people only make money by pushing their consumers to have more exposure to crypto assets or more exposure to stable coins, or theoretically stable coins, depending on their backing assets, that can create very significant risks, in addition to things like fraud, AML, KYC. That's a big focus. From our perspective, going back to your question in terms of the impact, it's very clear there's a strong political push out of the US at the moment for adoption internationally of USD stablecoins. There's about $289 billion worth of stablecoins issued around the world. 99.6% of that, as of last week, is US dollar denominated. There's about 200 million or so of euro. There's basically virtually zero of GBP, and even other currencies, including the peso, right? That's a very relatively small amount versus size of people's GDPs. That we think is probably politically unsustainable. So as people have seen in Europe with MyCar, there's a big push for euro-denominated stablecoins. And I think there's also some challenges in other jurisdictions, including LATAM, Southeast Asia, and others, where people want exposure to dollar for how well the regulators can control, particularly offshore provision of those services. And fundamentally, we're a big believer as a bank that governments and regulators need to control what is happening in their economy and need to control the risks of these new technologies. So net-net, our recommendations are actually very aligned with what Chile's already doing. And again, as one of the more advanced ecosystems we would see globally. The fintech law has already provided very clear rationale for how securities and crypto regulatory spheres should interact. What's really interesting, I think, also about Chile, you're moving very quickly to not just hum up with a basic regime, but to think through future implications. So staking, yield, the consultations out at the moment are very interesting for us. We also see, particularly on the AML and the requirements to increase services there, has to go hand in hand with opening up these technologies. So we think you're doing really the right thing. The only additional things we think potentially markets around the world should do is two. One, to think how a CBDC regime, so a digital peso issued by the central bank, and stablecoins will interact. We see there's some countries that are going anti-stablecoin and pro-CBDC, so China, India, two good examples of that. Very clear what you need to do as a business. Others, like the US, which are going clearly all in on private stablecoins. It's actually a law in Congress you may be aware of, restricting the Fed from actually even progressing pilots on a CBDC, let alone issuing one. And then there's countries kind of in the middle, which I'd probably say Europe, UK, maybe Chile is, where I think you're pro-innovation, so you support stablecoins in a controlled way, but you're also interested in issuing a digital peso. In reality, because of the speed of government development and central banks and the speed of adoption of stablecoins, I think there needs to be clarity in a country about which one you want to take preeminence. And particularly given the risks to commercial credit disintermediation, so limits being put on local CBDCs, other controls, you need to be careful you don't accidentally incentivize private stablecoins to be more dominant. And I think that's certainly a big debate here in the UK at the moment, also in Europe. We'll see, obviously, I defer to the experts. The second thing we would say is to really look at fraud. So fraud is ballooning globally, largely not things like account takeover anymore or card fraud, but largely around scams. So we as Revolut, as one data point, we're operating in these 41 markets globally. Around about 20% of the transactions we do globally is here in the UK. 70% of the fraud attacks we see globally is here in the UK. And that's largely being driven by social media, investment scams, crypto scams, other things being pushed out on big social media platforms. This, I would say, the UK is probably in the lead of, but it is coming to every market in the world, including Chile. So understanding how do we make sure we've set the right high barriers for commercial operators to deliver protections needed for their customers, but also for the broader ecosystem, has to be a priority. And for us as Revolut, when we look at the things we potentially want to do in the stablecoin space, so euro, GBP, dollar, things that are technically quite easy for us to do quickly, the two things we're taking our time over is regulatory engagement, to make sure regulators are happy with what we're doing. Turning this on, right, for 60 million customers tomorrow is having a big impact. The second thing is saying, what more can we do to control fraud? Because as cross-border movements and exchange between currencies becomes instantaneous, the ability for the cybersecurity threats to increase and for particularly collaboration between banks and regulators to become real-time is very necessary. And again, I think we're very bullish on whole of LATAM, but particularly Chile, to be in that advanced discussion. But we need to make sure we get it right before we open the doors to this new innovation.
Thank you, Adam. Pia, so what opportunities do crypto assets bring to Chile through the new Fintech law?
Well, the Fintech law is a basic framework to position, a much more secure infrastructure, not just speculation. What is important to understand is that it's just the starting point. There's still other regulations that needs to take into account to secure trust, like DLT laws, as it is, for instance, in Switzerland, because this kind of technology also allows to program payments, and that is something that we are not used to, and our legal framework doesn't care about. But what I think there is a potential in tokenization, in particular for our capital markets. We know that tokenization allows a much more dynamic flows of assets, and it's an opportunity for Chile to reboost our capital markets to this kind of tokenization, also because of the fact that we already have in Chile initiatives that have been working to give this trust and create this infrastructure, like AUNA, a blockchain that is a consortium of the DCB, of the Santiago Stock Exchange and GTD, a telco company. So this could be possible. And what could nudge this to happen would be if complement regulation in terms of the superintendency of pensions and the central bank could allow this kind of asset be part of the new generational funds. And this could put Chile again on the pension innovation on the forefront globally. And that, I would say, is the main opportunity. This has, of course, a lot of challenges for traditional, financial institutions, but at the same time, a lot of opportunities. We have seen already that some banks that have been moving to do some collaboration with fintechs in order to provide secure offering of this kind of assets. So it's super, it's a super opportunity. But I remember, the fintech law opens the door, but we need much more than that to make it happen. And I'm super convinced that if we make these kind of assets be part of the assets that pension funds could invest, all the financial industry and the fintech industry in Chile could boost, and we could become like a hub for institutional crypto financial infrastructure. Remember that we need to understand that crypto in general is the new technology of the digital era for money, okay, for value in general. It's the equivalent that a long time ago in China were promising notes when they were using coins, metal coins, for trading. We always forget that. And they start writing papers of the equivalent of the debt that was collateral by coins, and that model afterwards was evolved into the banknotes that were issued by the emperor, and now nowadays it's the central bank. But that is the way this new technology happened. So I encourage not to have concern or be afraid of crypto. Just think that it's a new technology that allows value to do things that we are not used to, and it's a change drive. It's going to be a disruptor of the monetary system as we know it in the future. And we are talking about 5 to 10 years. And that is not that much.
Thank you, Pia. Very interesting. So Solange, how does the fintech law address crypto sorry, I already did that. What has been the most effective tool or approach you've seen to fight fraud in the crypto space?
Let me just make some comment on what has been said.
Of course.
In terms of, before getting to your question, because I think it's very important to clarify what's the regulatory environment in the case of Chile about stablecoins, because I didn't mention previously. When you talk about stablecoins, that specifically is in the fintech law. So in the fintech law, we do have cryptos in general, but specifically we do have stablecoins as a potential regulatory mean of payment that should be regulated by the central bank. So it could be a means of payment regulated by the central bank as a stable coin. But that needs regulation to be issued by the central bank to that be the case. And also, the central bank, as you just mentioned, it's exploring CDBC. So we do have both things under evaluation somehow, as it is in many other countries, many other jurisdictions. And we, as a country, will have to see if this goes through one lane or both, but that's something to be seen. So, but when we talk about cryptos, one thing is stable coin, and that's fully backed by assets and some mechanism to be stable or not that stable, depending on the algorithm or depending if it's in reserves. And there's a lot of discussion about that. And that's a matter of the central bank to decide whether, but it has to be fully backed in the case of Chile. But when we talk about cryptos, there's two types of cryptos. There's cryptos that are like the usual cryptos that we talk about, Bitcoin, Ether, or all of that. And there's another type of crypto, which are a tokenization representation of a real asset, a real estate, or a security. And those kind of animals are different animals, I should say. In the case of the CMF, what we are regulating, and the regulation that we have already issued, is about cryptos that it's not stable coin, because that needs another set of regulation in terms of the issuance of those stable coins, but is on the service providers for these crypto assets that are that might be an investment or thought of as an investment, and that could be a Bitcoin, for instance. Now, in terms of what is the again, civil bullying. I was asked before in the previous panel what was going to be the one thing, those things of the one thing. There's no one thing. So again, there's no civil bullying about this. And there's a lot to try to a lot of risks that might arise and that we need to tackle. And those risks, of course, there's always the main thing, the most important thing is corporate governance. It's always risk management and good governance. I think that's the one thing, if I have to tell one, but that's not that alone. Still, we need to solve conflicts of interest, and as I mentioned before, vertical integration, for instance, is one of the things that has most concern concern in terms of other regulators as well. And segregation of assets and all of those things might be needed as regulation and enforcement of that regulation as well. So disclosure, very important, but governance and risk management is good, but it's not enough. Sometimes you would need capital requirements as well, as I've mentioned before, and of course effective supervision. And for effective supervision, we need to ask for information to be able to supervise. So, and one last thing, cross-border. These are cross-border products, so we need to coordinate between regulations. Information sharing is very important. These are services that are offered from one country to the rest of the world, and then to have to try to avoid regulatory arbitrage and to have the same standards everywhere, and information sharing, it's really important.
Thanks, Solange. So Adam, you already tested us. Almost everybody knew Revolut, a non-traditional bank. So tell us, what are the advantages of these new kinds of banks? What are the risks in front of, or as compared to traditional banks? And particularly, what are the risks on the implementation stage in which you are in many countries in the world?
Good questions. And I guess for full disclosure, so before I joined Revolut, I used to work for American Express, so kind of one of the oldest banks or payment providers. And then before that, I used to work for the European Commission about 20 years ago. So I was a civil servant. So I come at this with a maybe more regulatory point of view than if you ask my business and tech colleagues. So I think in terms of the transition we've seen with fintech and neobanks, I think going back actually to Solange's point, I think there's no one silver bullet that enables companies to be successful. There's no one silver technology that has transformed the world. What really neobanks like Revolut to some extent are doing are bringing together a variety of different technology trends and putting them together more effectively than anyone has done previously. And then using that to offer new services people can't get. Couple of examples, open banking, open finance, another place where the fintech law accelerated Chile. Here in the UK, they started that about a decade ago. Before we as Revolut really got into it, it was kind of being used a little bit by people, but not very much. Today in the UK, we as Revolut, just as one company, represent 20% of all open banking API calls. And for the more advanced use cases, we're 90% of that market. Now, all the other banks could have been doing that for the last decade, but they weren't. And why? Because they didn't have an incentive to. Open banking enables you to collect lots of financial information and bring it into one place. So when you're onboarding a new user that already has 3 bank accounts, super useful for credit decisioning. When you're maybe not the primary bank account, so you want to make it easier for someone to send money into their new bank account, super useful to use it. If you're Barclays, if you're NatWest, you get the money in your account every month from their salary, and frankly, the longer it stays there, the better for you. And so this embracing of new technologies hasn't really been driven by legacy banks in every jurisdiction. And then when you extend that to look at other things, so cross-border payments is another. Our founders were basically FX traders at one of the big wholesale banks. And they said, why on earth is it that cheap for banks to send money to each other when retail customers are getting charged 400, 500 basis points? And so we basically now today can offer cross-border currency, including into Chilean peso, on our phone between 40 different currencies. And 95% of the time, we offer that exchange within 1 basis point of the live interbank rate. So the all-in cost for the customer with AML fraud protections and everything, maybe 20 or 30 basis points. Again, HSBC could have built that product. They could have launched it, but they didn't because they were getting 3%, right? When people swipe their cards overseas, taking FX. So I think the real drive of neobanks and the reason that they've emerged is because there's a range of technologies. And I think actually you're going to see an acceleration in the future. And that's largely because of 2 things. One, tokenization. So tokenized securities, cross-border provision. It's definitely coming. Again, the US is pushing that this year and next year. The second is AI. So again, everyone says they use AI. Every bank says they use AI. In reality, I think you're going to see a transformation in the next 12 to 18 months. There's going to be banks that use AI to enable people to interact with those banks, and they're the people who are going to win. And there's people that just use AI for internal processes and cost savings. They're the people that are going to lose. And even for us, we haven't quite got to the point where you open your app and say, Revolut, GPT, please can you manage my money better? But I think we're starting to test areas in that direction. And going back to your point on robo-advisory, there's a lot of regulatory consumer impact discussions you need to have. Getting to the negative, though, or the challenge, right, in terms of the risks, they definitely exist. So from our point of view, a lot of digital banks around the world haven't figured out how to make money. So a lot of markets we go to, we're entering. There's 4 or 5 digital banks. They were all licensed within the last 5 years. All of them are not making money. They're just basically offering massive incentives for people to move their deposits in, cash burning, using all their VC money, and there's no sustainable model. We're quite lucky in because we've had a very diversified model. We've got to the point where we're now quite profitable. So we made about $4 billion in revenue last year, about $1 billion plus in profit. We're aiming to double that, but that's not off one product, right? It's off a variety. And like you say, I think the execution risks of neobanks with very light footprint, not large resources, not big tech stacks, competing is going to be a challenge. Our 2 takeaways, though, are fundamentally A, scale matters. So the bank that serves 500 million customers is going to beat the one that serves 50, and that's going to beat the one that serves 5. So there is a challenge, I think, coming for banks that only operate in one jurisdiction, whether you're a bank or a fintech, actually, or a payment company. Second is, I think, moving money from point A to point B is going to get very close to being free. And that means in the payment ecosystem, which is where a lot of fintechs, including us, started, I think it's going to get pretty brutal the next 5, 10 years. And if you're just operating in the payments ecosystem, whether stablecoins, CBDCs, instant payments, open banking, if you're sat there today taking 100 basis points, I think in the future it's going to be 5, 2, or 1. And again, the sustainability of those business models is going to be a challenge. And I think that does create some risks for regulators as they embrace fintech for competition, but need to manage the exposure of their clients. Thank you.
Thank you, thank you. So let's continue with the risks. So which is the risk, or what is the main risk of cryptocurrencies? What is it that we don't know or are not talking about?
Well, I would say there's mainly 3. The first one is regulatory arbitrage. Most firms that are focused on retail consumer, they tend to go to jurisdictions where their law doesn't requires too many secure or client, or don't take care about the client, where it's not regulation, and of course where taxes are low. And that is a risk because as they focus on retail consumers tend to use this kind of services. The second one is infrastructure dependency, because the market is very, very concentrated. There are very, very few exchanges that concentrate, like, a very big stake of the people who is investing, and this can create a shock, a systemic shock, if they have any kind of problem, and if they're in a jurisdiction where this is not regulated. I think that one good example, it was some few years ago, where an American exchange collapsed, and there was no regulation. Finally, it was mainly a Ponzi scheme. They were not doing what they were saying to the clients. They had very, very important clients, including people from cinema, sports, very, very well-known people, and these crashed the market and create a systemic risk. And the third one has to do with identity and recovery. The point is that until there is no deal identity framework that is secure and integrate with this kind of services, the customers is always in risk. And with a deal identity, we're not speaking on a password and a username. We're talking about cryptographic ideal identity with wallet, with standards, with cybersecurity standards. So that is super, super key, not just for these particular services, actually for all the services online. And there's no, people don't used to talk about this. I would say the only place where this is a very important issue, it's in the European Union, that has been developing standards and a framework for the deal identity and the wallet. And in Singapore, they have a real identity that is integrated with these kind of services, but nobody understands well the design in terms of who has the control, the person or the government. So you see, and that is super, super, super key. I would say, Macarena, those are the 3. Also, I would go back to what Solange spoke about different categories of crypto assets. There are much more than 2. Actually, what is different from, I would say, the traditional values that we know is that one single token can have different functions. For instance, Ether, mainly people mainly knows Ether, but because of a speculation, they buy it as part of their investment portfolio. But the truth is that if you create an application into the Ethereum blockchain, you need Ether to function and do transactions. So it has different kind of uses. Also, for instance, you have cases where a token can represent, a kilowatt of solar energy in a microgrid, but the same kind of token, it's traded in an exchange. One case, it's PO from Power Ledger, that is an Australian company that has a software that tokenizes solar energy in microgrids, and actually they are they have huge microgrids in Australia, they have done pilot projects in India, and actually 1 or 2 years ago, they started doing a pilot project in Chile with BHP in the north of Chile. So this is a different kind of animal, okay? And actually regulation in general, it's, I would say this is maybe is the fourth risk at the end, is that we are trying to push this different kind of multifunctional asset into a traditional financial asset. And it's not going to be enough. I just want to say that. And as Solange mentioned, regulation, it's local, but crypto assets is global. Now with the Genius Act, we're seeing the first case of a global regulation. Now, all the stable coins are back in the US. No matter where the company is set, they will have to comply to their regulations. So that is going to be interesting to see how evolve, not just with this particular asset, I would say in general with other in terms of regulation.
Thank you, Pia. Solange, so what does the fintech law bring of good to us from a technological and financial innovation perspective? Does it unlock liquidity? Does it broaden access to Chilean capital markets? Why is the fintech law good to us?
Yeah, thank you, Macarena. Well, hope it's a good news for everyone, because we have been working during the last, I was at the central bank before, so I started working on the fintech law when it was drafted while I was in the central bank. And it has been, as I mentioned, a lot of work, and I do think it's good news for our country. And indeed, when you think about the fintech law and what we have been doing in Chile, and you mentioned that, we are leading internationally, and we really get a lot of interest from around the world. So we're participating in conferences all over the place. There's a lot of interest in multilateral agencies, at the OECD, or at wherever we go. There is a lot of interest on what we are doing in Chile. So we're a reference point at the moment. And I do think that by itself, it's a good news. So now Chile is known because of the fintech law. We were known before for other things, but now we are known for the fintech law, I can tell you. And this is a very cross-border activity. So attracting international investors, as we are known by the fintech law, and that we do have an ecosystem where innovation can take place, and not just take place, but there is legal certainty about what are the rules of the game in the case of the fintech environment, and also a level playing field for the traditional financial sector as well. So that legal certainty in our country, that we're building it through regulation and through this law, I think it's another good news. And what we're doing is really understanding, or trying to understand as much as we can, these new business models to tackle the risks. And I do think that is also very, very important in terms of how to mitigate the risks that we observe. And of course, there are a lot of risks all over the place. The financial sector has risks. It's inherent to the financial sector activity. So that is something that us as financial regulators, we already know about. So this is a new kind of risks, that's true, but we know how to mitigate them through regulation, and there is a lot of expertise also around the world, and we are sharing those experiences around the world and putting them in to the regulation in the case of Chile. So that's another, I think, the advantage in the case of Chile, that we're building a robust regulation. And the third one that I think that the fintech law brings with is to boost technology, and boosting technology not just because of these innovative companies that are coming into our country or that already exist but are coming into the regulatory perimeter, but also in terms of the traditional financial sector. This is pushing the financial sector also, the legacy ones, it's pushing them in order to innovate, to catch up. Open finance is going to be a big challenge for everyone, and everyone is trying to wear their best suit in order to participate in this new system. So I think that is also something that's very, very, very good news for us.
Thank you, thank you. So Adam, you were saying that Revolut makes money from a lot of sources, and one of them is crypto services. You offer crypto services. So what's the lessons that you have learned from customer behavior? What are the regulatory challenges? What is it that you've learned when you've been opening Revolut in different countries, particularly in Latin America?
Yep. It's a good question. Maybe just one comment on Solange's point before I get to it. I think this idea of the legacy banks actually getting benefits from having increased fintech competition is really something we don't talk about enough. As a great example in Poland, so the local Polish banks, there's 3 large ones, didn't offer great customer services, didn't have great digital apps. We entered the market and they sped up pretty fast. And they ended up, because we were taking market share from them, they've now actually become so good, they're now, defending their market share successfully in Poland, but they're now entering other markets because they're now much better, right, than the ones that you see around, for example, Eastern Europe. So yeah, I do think that generally that fintech increase in competition, going back to my old regulatory textbooks, is fundamentally a good thing, right, even if there are risks. I think going to your point in terms of the lessons learned, so 3, probably I'd flag. First is, I think the reality of consumer behavior is not what models and what hypotheses predict. So for example, when we opened up our crypto services and we became authorized in different jurisdictions, whether it's here in the UK, in Europe, we're also applying for a MiCA license there. Our expectation was that it's going to be a bunch of young people, early adopters who really want to get into this stuff. In reality, it wasn't. Our average age, I think, for crypto and purchase is somewhere around about 40. So you had a lot of people who have, like, let's say, 1,000, 2,000, 3,000 euros, pounds, dollars, and you have that in their account, and they say, oh, keep reading a lot about Bitcoin, maybe I'll put 500 into Bitcoin just to see how it goes. So we had a lot of our clients testing and learning with very, very small amounts. So it was less than 5% of all of our assets into this space to educate themselves around it. So that was the first thing, which is don't expect it to be the users that you expect to use that immediately. It'll be a wide diversity. Second is anyone who tells you they know more than 5-10% of the ecosystem is either a fool or lying. The ecosystem is changing very, very quickly. As has been said, crypto assets is not a thing. It's a broad spectrum of different financial assets and providers, some of which are very good and very low risk, some of which are, I think, things that should not be allowed in the market ecosystem. And again, deciding where each of the different products are, I'll let you speak to, and obviously the regulators. But fundamentally, we need to get away from saying that crypto assets is one thing, and similar to stable coins. There's stable coins that are in no way stable because of their underlying assets. And then there are things that are basically a truly stable stablecoin that gets very close to a synthetic CBDC, where you put all the money with the central bank. Those are 3 very different products with different requirements. So what actually we've done with our customers is really try and educate them. So we had a product called something Crypto Learn and Earn, where basically we gave them modules on their phone where they had to go through and take tests, watch videos, take education. And at the end of it, we were given like 1 Polkadot or 1 Solana, right, to kind of incentivize them to look how it went. What was really interesting, what we loved also talking to regulators about, I think it was more than 65% of people that went through that learn and education process did not then use crypto asset services. So this was not a way just to get more people to use it. It was a genuine effort at education. And I think particularly the ecosystem needs to do more of that. More not trying to convince people just to download and buy and sell, which is what pure play crypto providers do, but do it in a more diversified way. And then the third thing I'd say is sustainability of business model has to be the key question from regulators, in my opinion. Like, people are always going to sell you on the great consumer benefit or the wonderful things that they're bringing in terms of innovation. But if people aren't making money transparently and sustainably, that is creating very significant risks. And so one of the things we constantly talk about is we kind of feel regulators should do more to encourage traditional banks to offer very dull and very basic crypto services. So to explain the rationale for that, if, for example, which was a bit of a debate, I think, in Europe with the ECB for a while, they didn't want banks anywhere near the crypto service or the stablecoin service, what happens? People, consumers in the market, will go and download some other pure play crypto app, maybe offshore, maybe cross-border, but clearly in a less strongly regulated environment. And so in my opinion, what you really want is JP Morgan and Barclays and BNP Paribas and UniCredit and others to offer buy, sell, hold crypto in a very controlled walled garden in a place where they want to make sure their customers do not take very much risk. And that's our view, right? We want people to take a 30-year mortgage from us. We want them to be buying and selling on their cards every month of the year. We want them to invest in stocks. We're happy to facilitate investment in crypto. But particularly on those last two, we do not want large amounts of risk, because that large amount of risk will remain on our balance sheet, will be a loss that we'll face. My concern is that pure play crypto providers don't face that rationale, don't face that incentive. And that's why I think the regulatory approach somewhat over the last 5 years has been said, get a crypto license and do what you want to do over there. I think there should be a little bit more of a discussion about saying, if you're a bank, full prudential regulation, complete oversight, maybe it should be a bit easier for you to offer those very dull, basic crypto services, because then that saturates the market. And I think the good thing about that is that means that most of your exposure to these services will be done by big local institutions the regulators have a high level of control over, not foreign providers that maybe even get a local license, but with very light headcount, light regulatory engagement, light kind of investment in the market. And so again, we would say that because we're a bank, but we think leveling that playing field and trying to make sure banks control their exposure but are able to offer those services is a way of, again, managing the broader risk.
Thank you, Adam. Yeah, so how are crypto services addressing cybersecurity and digital assets custody safety? What is it been done to keep consumers' trust?
Well, these kind of services, custodies, and also cybersecurity, they have shifted into traditional finance standards. Okay, they're moving towards that. They're having like real-time monitoring, multi-signature for opening wallets, and all those kind of things. But what you can see is going back to the EU. This is not enough. I mean, it needs to be aligned and integrated with digital identity. And we are not just talking with a digital identity that has our root in Chile, our name, our birthday. We're talking about wallets that also include health information, financial information. And a super interesting case of all this happened in Spain. You know, in Spain, the digital identity standard that the EU is using started in Spain, in Alastria, that is the blockchain consortium. And now, while the European Union also is working on the framework of the wallet, you know, for instance, the bank, the financial system, is moving and they're working on Dalion, that is a infrastructure for upgrading the standards on cybersecurity and integrating it with the digital identity, with credentials that, as I mentioned, is not just your name, and birthday is much wider than that. So that is how it is evolving. You know, what I want to say before ending this panel is that crypto assets allows, sorry that I keep saying this, but it's true, allow business model that we are not used to. For instance, today, if every time we put our money in a bank, the bank takes the money and use it for a loan for another person. And you have also to pay for, you know, keeping your money in the bank. But the truth is that with programmable money, as it is in crypto assets, and uses this kind of technology in the financial system, you, for instance, could have you should be the person who, through digital identity, consent to let the bank use this money and for a loan, and then you can also could have, for instance, a revenue, a part of the revenue of the profit because of that money that has been, has created a profit for a bank. So it can share value. So that's why we are opening that kind of things. Tokenization means that you can also tokenize the money that you have in your bank account. So it's much more wider. And it's important that we address this opportunity because also it means financial inclusion. It means sharing the value. And we need to be open for this, open our mindsets that also these kind of things could be super attractive. We need to understand that this ecosystem also is already testing this kind of business model in decentralized finance. And in 2020, it boosted to 1 billion capital market. Now it should be more or less 2 billion. So this is happening, although we are not seeing it, it's already there. And new generations are very, very interested on assets that use this kind of infrastructure because they feel that give trust and ownership, because that is also something different that we are not used to. With crypto asset, if you have the private key, you really own the asset and you can use the asset whenever you want. Today, you have your bank account, but if everybody goes and wants to ask for the money, it's not going to be enough money. So it's different. And all these kind of, I would say, challenges, for instance, are also being addressed in the European Union. The central bank in the European Union is working on the coming years, open the wallet and giving all the European citizens 3,000 euros, and they're designing all these kind of capabilities. Will the people own their money? They will have or not have the private key. These are important things to address when we are talking about these assets.
Solange, I'm not a face reader, but I read that you can say something.
Yeah, I can say something. I can always say something. Now, with respect to crypto asset service providers, again, in the case of Chile, we do have all the services, and indeed, what you're talking about is exactly what crowdfunding would be, right? Because then you're investing in a project that has a tokenized version of your share, and then you're investing directly on a certain asset, and you're the owner of the asset. And that's where I wanted to go to, because how many lawyers are in the room? That's just everybody. Well, okay. When you talk about with lawyers, it's challenging. When you can challenge if one that owns the token owns the asset or not. It is challenging. So you own the token and you have the key, but in order to, and we're struggling with that, and as we are regulating these things, how we make sure that the ones that owns the token can prove and say that it's the owner of the underlying asset. Those type of things need to be solved well when you're drafting regulation and what. So there's a lot of opportunities, but there's a lot of challenges as well, and there's a lot of risks, and in the custody and the rules of who has the keys and the custody of those keys. There's a lot of challenges around the cryptos as well. So opportunities, but challenges too.
Exactly.
Just briefly to add to that, I think that isn't, again, just in the crypto space. I think that's exactly right, even in other areas. So tokenized deposits and versus stable coins are two slightly different things, but from a legal architectural point of view, they're radically different. Because at the end of the day, a tokenized deposit, if there's then a liability on the bank, and then that bank goes bust, but those tokens are held by people, let's say, in Guatemala or Vietnam. This means now citizens of those countries have a claim under the liability insurance provided by the regulators that has been financed by the local population, depending on your jurisdiction. So again, I think this whole idea that you're putting anything on a blockchain or any DLT which can move cross-border radically changes the entire framework of legal thinking around what is money. And I think that that's something that we're not great as a global community on really doing on a cross-border basis. I pick any challenge, right? Climate change through to illegal money trafficking and whatever. I think the challenge of this is that technology is moving much, much faster than the ability of regulators and governments to get together to put a framework. And that's why, again, from our point of view, going back to your point of decentralization is coming, I agree. I personally, probably the ex-government person in me, I still believe in sovereignty and the control of governments and regulators. And I think in some places, it is just a matter of will, political will, to exert that. And I think it is necessary. Otherwise, we're going to end up in a bigger problem in the few years.
Okay, thank you.
One second. Also, it's important to understand that depending on the asset, it's not just blockchain technology, okay? Because if you have a physical gold lingot, for instance, you can have embed a microchip that has the ID of that specific lingot, and also can have the location, for instance, and you tokenize the lingot on a blockchain or any kind of DLT technology, and then you can, in some way or another, you can use it for trading or even for buying a coffee if you have an exchange that wants to buy it. So what it means that tokenization is much more wider depending on the asset. Also, for instance, paintings. I mean, we know art funds, but they're tokenizing art, and what they do is that they embed a microchip on the canvas of the and then they tokenize, because they also need to know where it is. So it's much more, it's not very like. It's not something that, it's just a digital representation, just a code, and that represents something that I say it exists. Sometimes you really match it and connect it in the physical world. And we are now just speaking about trading among people. I can tell you that I'm a member of a company that already have a token that is approved by FINMA, that is the Swiss regulator, to trade between machines, autonomous machines, okay? Because, so data, it's money. And sometimes even machines can have money in their wallets to, for instance, an autonomous car, that wants to charge battery. So we need to speed up on the topics too, because that world happens. In the case of Chile, Enel, used Chile for testing their technologies. So there's a lot, Chile has so many assets that has a lot of value. Green energy, that's why it's so important, the FinTech law, because it's an initial framework, and we could really boost our economies.
Thank you. Solange, Adam, any other final remarks besides to what Pia was talking us about?
I think on my side, I said I always can say something bad.
It's what my wife says about me as well, so I'm not sure.
No, I think we do have big challenges ahead, but as I just mentioned, there's a lot of opportunities as well. In the crypto asset world, it's not just Chile's challenges. It's all over the place. IOSCO has a set of recommendations that were issued very recently this year, indeed. The EU is working on it with the MiCA. So everywhere, we do have a world. I think I would like to say that we do have as a world a good problem to solve, because we do have technology, we have a lot of opportunities that go with it, but we have to do it well.
Maybe my last comment more as again, an external perspective. Again, I interact with a lot of regulators, a lot of different legal jurisdictions around the world. Fundamentally, we see Chile as genuinely not just saying this because I'm sat next to the regulator, a genuinely advanced market, not just in Latin America, but globally. I was in Singapore a few weeks ago. We were talking about a bunch of different jurisdictions. Chile was one of them. Our CEO, Julian, who actually is leading some of our expansion in Latin America, he's based in Chile. And so again, the talent we see there that we can hire and recruit is really top-notch. And exactly as you say, I think technology needs support by regulators. It needs controls. But what people like us really like is clear rules. Clear rules mean we can unlock an investment, put money in, and launch very quickly. And that's, I think, what the fintech law's done in Chile, set a very strong framework. It's going to keep evolving. That's why I think we're excited. Let's see how fast we can do it. Maybe next year, maybe the year after. But to be here, and I won't be how many hands up have heard of Revolut, how many have a Revolut Chile account. And then we can see how we do progress. But thank you very much.
So friends, I'm afraid we don't have time for questions, but I hope you may find these guys on the coffee, and let's give them an applause.